A recovery in China's manufacturing activity has buoyed the economy while also creating frictions with the West, as companies flood overseas markets with cheap goods amid anemic domestic demand. China's Purchasing Managers' Index came to 50.4 in April, falling 0.4 point from March, but topping the 50-point mark, separating growth from contraction for the second month in a row. The index tracks manufacturing activity across 3,200 companies, based on new orders, production levels, employee numbers, and other indicators. Increased output of automobiles and telecommunications contributed to a 0.7-point rise in the production subindex, which helped lift the overall PMI. Manufacturing has been driving the Chinese economy since the beginning of the year. Industrial output increased 6.1% on the year in January-March, outpacing the 4.6% growth for 2023 as a whole. Real gross domestic product grew 5.3% on the year in January-March, compared with 5.2% in October-December. The figure remains above the official around 5% target, but domestic demand has been sluggish. The subindex for new orders topped the 50-point mark in April, but still fell 1.9 points from March. New orders from abroad were down 0.7 point. Nearly 60% of PMI survey respondents said demand was lacking. China's real estate sector has struggled in particular. New home sales by floor area dropped 23.4% on the year in January-March, outpacing the 8.2% decline logged in 2023. New home inventories have surged 23.9%. The glut is expected to discourage new investments by property developers. It could also squeeze demand for goods like furniture and home appliances. Meanwhile, the People's Bank of China faces growing hurdles on additional rate cuts. With the yuan weakening, the central bank in April decided to keep the loan prime rate steady. Looser monetary policy could accelerate the flow of capital out of China. At the same time, many private sector companies say they face an uphill fight to secure financing. One index measuring the corporate financing environment, compiled by the Cheung Kong Graduate School of Business in Beijing, has remained below 50 since June 2023. In response to weak demand at home, more Chinese businesses are selling excess supply overseas for cheap. This has led to new trade frictions with the US and Europe on electric vehicles, solar panels, and other goods. The European Union is now investigating whether Chinese EVs subsidized by Beijing are distorting the market. Further overproduction could exacerbate such problems. Copper prices are showing a positive sign for the Chinese economy. China accounts for 50% to 60% of the world's demand for the metal, which is used by a wide range of manufacturers. It is also traded by speculative investors. Its price reached a 2-year high on the London Metal Exchange in late April. Still, domestic demand will likely remain weak, said Naoki Tsukioka, chief economist at Mizuho Research Technologies. He also predicted that China's property slump will persist at least until the end of the year.